Good evening, everyone. I want to thank you all for attending tonight. We are introducing the Betashield strategy here at Berry Financial Group. We've got a couple great guest speakers that I'm very excited to introduce you to. My name is Reid Mathews. Berry Financial has been around since 1987. We serve 3,000 amazing clients that we feel very blessed to serve. And the Betashield strategy that we're going to talk about tonight is a market-based investment. However, it has a risk mitigation strategy that really protects the downside, which we will talk about in detail. You know, we don't believe in perfect products. We do believe that you can accomplish perfect planning. And we do also believe, and this will never change, that as you get older, you should be safer with your money. We've got our average age client is 65 years young. And once you reach a certain point, it's not about making a ton of money. More specifically, it's not losing a ton of money. The guest speakers that we have tonight are Tony Parish, the Chief Investment Officer at Alphastar Capital Management. Alphastar Capital Management is our registered investment advisory. So they are our RIA. We are investment advisors of the registered investment advisors. So very interesting terminology, if you will, but they do our compliance, and they are our professional money management team. So at Berry Financial, we are your wealth counselors. We are your financial planners, your financial advisors. Between myself and Mr. Berry and the Berry Financial team, we are your advisors. So to use Alphastar, you come through us. That's very important because Alphastar is not right for everybody. Just like annuities aren't right for everybody, just like life and long-term care insurance isn't right for everybody. So there's no perfect product, but when we use Alphastar Capital Management, we've got some incredible professional money management teams, and I want to introduce you to Tony Parish and Brooks Riley. It's an incredible honor and a blessing to have them in on the call tonight. We are in week 5 of our 7-week webinar series. So we had no idea we'd be doing a webinar series January 1st of 2020, but COVID-19 came along and absolutely rocked so many people's worlds. And you know, the good Lord is in control, and that's what we maintain our peace with. To introduce you to Tony Parish, he's been Alphastar's Chief Investment Officer since April 2019. And he guides Alphastar's investment policies, his money manager partnerships, and portfolio model offerings. Tony brings a wealth of experience to the Alphastar team. Most recently working with Sage Advisory Services in Austin, Texas, and he's helped manage multiple objective-based investment strategies, and he served on the firm's investment committee, providing input on over $12 billion. That's 12 billion with a B. Tony's worked in product development and analytics with Duche Asset Management, Credit Suisse, and Oppenheimer Funds in New York City. He's passionate about working on financial data, science projects. Yes, science projects. Tony is a self-proclaimed investment geek, and that is exactly what you want with somebody handling your money management services. No doubt about it. He specializes in quantitative modeling of multi-asset portfolios. Tony is a chartered financial analyst, a CFA, and he holds a certificate in quantitative finance. He's earned his MBA with a concentration in finance from Fordham University in New York. His favorite activities include movie watching with his wife, Bethany. I believe Tony told me they just celebrated 26 wonderful years of marriage. So congratulations to them. And his son Robert, as well as recording buttery R&B bass tracks with his Rickenbacker bass. We're also got Brooke Riley, the Vice President of Advisor Consulting at Alphastar Capital Management. He's been a good friend of mine for a couple years now. I've asked Brooks more questions under the sun than you can ever imagine, and Brooks has always shown me kindness and given me some great advice. Brooks works with Alphastar sales and marketing teams, and he works to prospect, onboard, and coach newly investment advisors to ensure they're able to efficiently and properly build a productive advisory business. He brings in over 8 years of sales experience in the investment management industry. Brooks attended Northeastern University in Boston, Massachusetts. I don't think he's got a huge accent, but we'll see tonight, where he graduated with a Bachelor of Science degree in Business Administration with a concentration in finance and investment. He then moved to New York City to be a financial consultant, but after 3 years, he then moved to San Francisco to recruit new broker trainees, as well as manage a book of high net worth individuals. Brooks is now currently in Charlotte, North Carolina, doing an incredible job at Alphastar Capital Management. So we're very blessed and honored to have them, as we do with all our webinars, especially in times like this. I do want to read a handful of Bible verses, because at the end of the day, the Lord can give you peace here on earth that the earth cannot give you. So we want to make sure everybody knows we are absolutely praying for you. People's sickness, their jobs, they're dealing with a ton of issues. And we want to know that the whole Berry Financial family, as well as Alphastar Capital Management, are praying for you, because Joshua 1:9 says, be strong and courageous. Do not be afraid. That's difficult at this time. Do not be discouraged, for the Lord your God will be with you wherever you go. Psalm 56:3, when I am afraid, I put my trust in you. And Proverbs 3:5-6, trust in the Lord with all your heart and lean not on your own understanding. In all your ways submit to him, and he will make your path straight. So God is good. If it's not good, then God's not done. I truly believe that. Once again, I want to thank everybody. Brooks and Tony have an incredible presentation for us tonight. And with that, Brooks, I'll let you share your screen, and we'll keep on keeping on.
All right. Thanks a lot, Reid. Give me 1 second. All right. Thanks, Reid. We're honored to be here. We really appreciate you inviting us to speak on your webinar series. Thank you to all the participants on the call this evening. This is Brooks Riley. I'm coming to you live, quarantined in my living room just outside of Charlotte, North Carolina. I head up one of our consulting teams over at Alphastar. I work with a lot of advisors, just like Reid, help them, as he mentioned, grow a good advisory business. So I'm going to kind of act as your host tonight and let Tony do most of the important speaking, because as you heard Reid describe, he is a lot smarter than me. So let's see. All right, so some important disclosures. Just our goal this evening is to provide you with some relevant information and educational content. This is not an offer or solicitation to purchase any specific securities or investment strategies. So as Reid mentioned, the follow-up to this would be to get with Reid and Berry Financial to discuss your situation, see if any of the things that we talk about this evening could be a good fit for you. Quick overview of the topics we're going to be covering. We're going to hear from Tony about what he's seeing and, more importantly, what he's paying attention to in the current market environment and what that means down the road. We're going to talk about some of the fundamentals of wealth management and how they relate to a financial plan and building your wealth. And then finally, we're going to discuss the Betashield strategy in more detail, talk about how it works, what it's good for, and how it might be a good fit into your financial plan. So from there, I will hand it over to Tony to give you his market commentary.
Great. Thanks, Brooks. Thanks, Reid. And thank you, everyone, for joining us this evening. We realize that your time is valuable, and so we hope to make very good use of your time over the next half hour or so. So let's start with the basics. The COVID-19 pandemic has rapidly spread throughout the entire world. You know that. It surprised the global capital markets with its severity and its magnitude. It took the world by storm. It is a textbook example of a black swan event. Nobody was aware of this novel coronavirus a year ago. Everybody is aware of the novel coronavirus now. That's why we are all dialing in from our living room. Attempts to control the spread of the virus quickly resulted in what has become widespread social distancing. And this social distancing, this quarantined environment, this environment where we're all connecting digitally using our phones and our computers, this widespread social distancing will persist for an unknown period of time. So those are the basics, you know that. Let's go capital markets. Can we pull up? There it is. So this is a chart of the S&P 500, and basically the dramatic fall of the S&P 500 really began on February 19th. The index dropped over 33%. It basically lost a third of its value from as it fell. It had an incredible comeback. It's come back more than 21% between March 23rd and April 9th. It's actually up a little bit higher now than it was on April 9th. So we had a question. Let's go to the next slide, please. The reason that we had such a big bounce, the short answer is a kitchen sink response from the US Federal Reserve, the US Treasury, from Congress, and from the administration. So responses to the pandemic, I've listed some here on the screen. Legislators passed the CARES Act, and it was signed into law by President Trump. $2.2 trillion of relief efforts that include direct payment to households, $500 billion for the Federal Reserve's activities, $349 billion in the Small Business Administration Program, $340 billion in emergency funding, and that mostly is going to states that support hospitals as well as local governments. And there were plenty of other measures that were written into this CARES Act that came out. Next slide, please. In addition to what the administration passed, the Federal Reserve really took a fire hose and drenched the markets with liquidity. It took several pages from the playbook that it was playing from in 2008 during the financial crisis. It lowered its target Fed funds rate close to zero. It authorized securities purchases, including treasuries and mortgage-backed securities. It authorized up to $2.3 trillion in loans to support households and employers and the financial markets, as well as state and local governments. And very importantly, it set up currency swap facilities with other central banks around the world to allow other countries to pledge their currency and receive dollars that they could use in the international markets to accommodate the trades that they wanted to accommodate. For instance, if you're buying oil in the international markets, oil is usually quoted and transacted in US dollars. And so central banks around the world needed quick and plentiful access to US dollars, and they were able to do that through the Fed's currency swap facilities. So all of these activities that the Fed did, they did to ensure that the credit continues to flow to households and businesses and the markets. And so the financial system doesn't amplify the shock to the economy that's come from the virus. So the combined fiscal and monetary and financial activities help the markets to reverse much of the damage that was caused by the quick downturn and result in a very quick bounce back. Let's go to the next slide, please. So this extreme drop and the extreme bounce has prompted a lot of individuals to predict that we may have a V-shaped recovery. I mean, after all, the world adapted quickly to the pandemic. It seems feasible that economies could simply restart when the time is right, and there's been a lot of discussion about that. However, we should point out that restarting the economic activity amid a healthcare crisis is probably a slower process than stopping the economic activity in the first place. It's not so much the monetary and fiscal response that's going to be the critical element to restarting the economy. It's really going to be the public health response. So over the coming months, we will begin to see a lot of data coming in. In fact, we started to really see it this week, economic data that really measures the impact of this virus. And frankly, I want to be perfectly honest, a lot of the data that we're going to see over the next month or two is going to be scary. It's going to compare the current environment to the environment of the Great Depression in the 1920s and 30s. For instance, the second quarter GDP growth, economic growth, may contract at a projected annual rate of 25% to 35%. I mean, that's huge. That's jaw-dropping. Unemployment, we've seen all of those jobless claims. We had another 5.5 million people announce that they filed for jobless claims just last week. That means almost 22 million people filed for unemployment in the last 4 weeks. I mean, these are jaw-dropping numbers. So be prepared that a lot of severe economic data will come out over the next month or two. So the question remains, will the negative shocks be short-term in nature? How destructive will the pandemic ultimately be? Well, from my perspective, the answers will be heavily determined by the length of time that it takes to establish conditions where social distancing can be relaxed. And really, that is what is the major topic that's being discussed today. When can we begin relaxing the social distancing measures? If the current conditions last 1 quarter, for instance, then the US economy could come back relatively quickly, could come back later this year. However, if they last longer, then the destruction to the economy will be greater. And that could possibly result in more of a U-shaped recovery, or maybe a W-shaped recovery if we relax social distancing and then we see another outbreak of the virus later on in the year. So the good news is the entire stock of human ingenuity is working on the solutions. We will overcome this crisis. You know, Reid had the one of the verses at the beginning of the presentation, Joshua 1:9, that said, "Be strong and courageous." We should be strong and we should be courageous, because we will overcome this crisis and the economy will recover, and the markets will reward different companies and different endeavors that are most relevant in the post-COVID-19 era. I would say that over the next 6 months, the goal should be less about making money for the average investor as it is about preserving capital. However, as we get into the latter part of 2020, hopefully that will be a time when the economy is really starting to get back on its feet. And that's a time when we can focus on building capital over the long term and get out of a more defensive posture that investors seem to be in at the moment. So why don't I stop there on the market commentary, and let's continue with the rest of the presentation, Brooks.
Yeah, thanks a lot, Tony. That is some great insight. We're going to kind of take a step back from the current to the theoretical here, and talk a little bit about growing your wealth and wealth management, some of the fundamentals, the fundamental building blocks that we look at in wealth management. So Tony, what are some of the more important concepts when you approach the topic of building wealth?
Yeah, great question, Brooks. So as I like to point out, asset allocation, which I'll generally define as, you know, your investment exposure to the broad asset classes such as stocks and bonds. Asset allocation will explain about 90% of the variability of your returns over time. There's been lots of historical research that's been done on the topic. So it's not about market timing, really about determining when to step in and step out of the markets. It's not about trying to use your gut to say, today's going to be a good day, I think I'll invest, or today's going to be a bad day, I think I'm going to get out and sell out of my positions. It's really about systematic investing. And what I mean by that is really determining what is the right amount of risk and the right asset allocation for you as an individual, and about putting in place that financial plan that you can do in conjunction with Berry Financial, and making sure that that plan is put in place and that you stick with that plan. Now, that doesn't mean just blindly following the markets up and down. We'll talk about some smart ways to make sure that you have the right exposure to the markets as the market environment changes. But essentially, you want to make sure you have a plan in place and you stick with that plan. And with that, I would say you need to have certain building blocks in place and understand what the role of the various building blocks happens to be. And
Great, yeah, so that leads right into the next question. Sorry, it's just what are the few primary building blocks of building wealth and a good strategy, and what's their primary purpose in a portfolio?
Yeah, great. Thank you. So you put it up on the screen there. I would say that the broad investment types, as I see them, are stocks, bonds, and I've listed annuities here, but you could broaden that category to include a broader range of insurance products. Sure, there are other things like commodities and currencies and other things that can be included in the securities world, but let's just stick with stocks and bonds right now, because for me, they provide the fundamental building blocks. So for stocks, what's the purpose and what's the cost? The purpose of stocks is to accumulate wealth, to grow wealth over time. You invest in a company, the company grows, the stock price goes up, you build your wealth. However, there is a cost, and the cost is there's a risk of sustaining market losses. Remember that chart of the S&P 500 that I put up on the screen? It dropped over a third of its value over the course of less than 3 weeks. So there is the potential risk of losses. What's the purpose and the cost of bonds? A lot of people think you own bonds in order to generate income, and I think historically that was the case. However, over the last 10 years and for the foreseeable future, I don't think bonds are really a good source of income because interest rates have been very low. I say the purpose of bonds is to be anti-fragile. What do I mean by that? It means they provide a buffer that helps to sustain your wealth when your stock allocations go south. In fact, they strengthen during times of market volatility. And we've seen that in the treasury markets. For instance, over the last 6 weeks, stocks have had a lot of volatility. And if you had invested in treasuries, especially long-term treasuries, there's been a massive flight to those treasury securities, and they have really gotten stronger over time as the market volatility has picked up. The cost, in fact, of owning bonds is low income. It really is kind of an opportunity cost. You're accepting a low amount of income for the ability to have safe areas of your portfolio that will protect you and potentially strengthen during times of market volatility. And then finally, what is the purpose and cost of annuities or insurance products? Well, annuities, they fall into a broad category, a broad group of categories, I should say. They typically have defined outcomes, such as providing guaranteed income or providing some exposure to an underlying index while protecting against the downside. So there's a broad range of goals that are associated with annuity products, but they also have a cost. For instance, if we have a roaring bull market, being in an annuity product may not perform as well as the stock market. Also, if there is a life-changing event and you need to essentially liquidate some holdings to be able to free up some cash, there are at times some liquidity constraints associated with annuities. So the point is, we've got these basic building blocks, and as long as we understand the purpose that they serve and the cost associated with them, we can put together a smart plan to utilize them properly. There's some quotes at the bottom of this screen. If we put them up here, the role of bonds, I believe, is largely misunderstood. Stocks plus bonds combined can be very effective. And we have additional tools such as annuity products, et cetera, that can provide a better experience when combined with stocks and bonds.
Perfect. I appreciate that, Tony. So I want to move into next. We're constantly hearing about diversification in the world of investing. But in my opinion, I've seen it pretty regularly misunderstood or misused. I like to equate it to the word organic when you're buying food. Most people know it's probably better, but don't really understand exactly what it means or why it's good. So why does diversification, what does it really mean? Why is there such a large amount of emphasis put on that in the financial industry?
Well, the best part of diversification is it has no pesticides associated with it. No, I'm kidding. So what we've done here is we've created a hypothetical illustration with stocks on the left and bonds on the right. The blue bars represent the activity during a bull market. The gold bars represent the activity during a bear market. So for stocks on the left, when there's a bull market, let's say the stock goes up by 6%. And when there's a bear market, it goes down by 4%. Whereas bonds, when we have a bull market in stocks, they may underperform in value because interest rates are going up, but they'll be very modest in their decline relative to stocks, let's say -1%. And if there is a bear market in stocks, those bonds may increase in value, such as we've seen with U.S. Treasuries over the last month or so. The point is, if you just invest in stocks or you just invest in bonds, you may have negative returns if the market environment is not suitable for those investments. But let's go to the next slide and see what happens when we combine stocks and bonds in a way that's intelligent. So the left-hand portion and the middle portion of this chart are just a reproduction of what we saw on the previous page. What's new on this slide is the right-hand portion of this chart, which basically incorporates a 40% position in that stock and a 60% position in that bond to create a single 40-60 blend. What we see is that when there's a bull market, this 40-60 portfolio has positive returns. And when there's a bear market, this portfolio has modestly positive returns, close to zero, but it's not losing money. The point is, we use diversification because nobody has a crystal ball. Nobody knows what the market environment will hold. If anyone had told you in January of this year that the S&P would be down more than a third of its value in 6 weeks' time, nobody would have believed it. And so since we don't have a crystal ball, we need diversification to protect against the downside. There is a cost, and that is we limit the amount of upside that we can experience at any given time. But the good news is we also limit the downside. Diversification creates a less volatile experience than a less diversified portfolio. That's what it comes down to, Brooks.
Okay, Tony, so you've constructed a well-diversified portfolio. It lines up with the amount of risk you're willing to take versus the amount of returns that you're expecting. What are some of the major missteps or mistakes that you see from investors, and how might they be avoided?
Well, let's look at what this chart does. Is it plots all the times from 1989 until the end of last year, where the S&P 500 corrected by more than 10%. Those are the gray lines. We then took the average of all those gray lines. By the way, we're looking at from peak to trough, or I should say from a 2-month period before the trough to a 2-month period after the trough. We took the average, and that's represented by the dark solid line on this chart. Then what we did is we looked at what bonds did during this same period of time and took their average, and that is represented by that squiggly dotted line at the bottom. What we see is that a lot of investors believe that bonds will be just as volatile as stocks will. And that's clearly not the case as long as we're talking about high quality bonds. So the point is, when we combine high quality bonds with some of the stock allocations, we can reduce the volatility of the portfolio in general. It's really a continuation of what we talked about on the previous slide. Now, you could tackle the market uncertainty through asset allocation. To answer your question, Brooks, what mistakes I see is a lot of people, when the market goes down, they sell out and then they miss out on the market rebound, thereby ensuring that their returns will be less than the returns of the overall broad market. So you can use asset allocation, that is the combination of stocks and bonds, to weather the storm. Or sorry, I think I got cut off there. Were you able to hear me?
Tony, it's a good
No, you
thing.
cut out for about 20 seconds there.
Hey, Tony, it's a good thing you're not the chief technology officer, my friend. You stick with the investments, okay?
Indeed, if I were the chief technology officer, we'd all be in trouble. I apologize. My computer automatically muted itself. It was kind of like Siri misunderstood and thought that I wanted to go to mute. I apologize for that. In any case, I'll just recap what I said at the end. Investors could try and time the markets, but I believe that's a mistake. A better approach is to use asset allocation, such as stocks and bonds, to buffer the volatility in the capital markets. And there is another way to create a less volatile environment, and that is through systematic risk mitigation, which we'll talk about in the next few slides. So on this slide, we have an example of the S&P 500. This is an actual downturn in the, this was in the fourth quarter of 2018 going into 2019. And you see that there was a big downturn and then a rebound. But what if you could create instead of panicking and saying, oh my goodness, we're at, the markets have sold off so much, I'm going to sell. What if we could create a situation where we could trigger a signal that told us when to get out of the markets? In this case, that signal is represented by the dotted red line. And we stay out of the market during part of the downturn. And then it tells us when to get back in to participate in further upside. What if we could do such a thing? Well, if we could de-risk and then re-risk based on some kind of smart program, that could really result in lower volatility and a better experience for the investor. And I think that this risk mitigation strategy is possible. In fact, it's something that we have worked very hard to develop, and that is what we deliver in the form of our Betashield strategies.
Perfect. Thanks, Tony. That was such a convenient lead-in to the discussion of Alphastar's Betashield strategy. Joking aside, we very intentionally built the Betashield strategies based on some of these fundamental concepts that we just discussed. So that's why we wanted to lead in with that. And we wanted to help the end investor through their financial advisors easily get access and be able to implement some of these strategies if it fits into their financial plan. So we'll talk real quick here about Betashield. Some of the key risks that we want to address in Betashield is the loss of capital, obviously, simply losing value in your investments, or you'll probably hear us talk about that sometimes and refer to it as a drawdown. The lack of upside potential. This relates to being too conservative in your portfolio and not really having the ability to achieve the expected returns when the markets are going up. And then third, and I think most importantly, through my experience as being a financial advisor and working with financial advisors, is investor behavior. So again, one of the biggest things that always pains me with a lot of investors is seeing them participate in emotional panic selling after the market has already taken a significant decline, or on the flip side, seeing them execute that euphoric buy. So after seeing a ton of hype in the news, after the asset has typically already had a huge run up, I'm sure you've seen recent examples of some of these are going to be your cryptocurrencies and Bitcoin. Also, some of your marijuana stocks as well. So moving along here, everyone wants to grow their wealth. And you hear it a lot when you sit down with a client. They say, I want you to make me a bunch of money, but I don't want you ever to lose me any. And unfortunately, the truth of the matter is that is not possible to have full participation in the equity markets when they're going up, and then no exposure to the downside when they're going down. So here, what we kind of think about when we talk about the Betashield strategy on this slide is that what we can do is implement a strategy that can give you protection against those larger, more catastrophic type losses on the downside, like a 2008 type financial crisis, while providing the opportunity to have a more aggressive allocation and participate more fully during periods of a prolonged market uptrends in the market, like the periods you can see here between 91 and 99, 2002 and 2007, and 2009 to 2019, realistically. So we will dig into the details a little bit here with Betashield and how we accomplish some of these strategies. Again, we took a lot of time and effort in developing the Betashield strategies to address some of these key needs and some of these key risks that we see investors deal with on a daily basis. So Tony will take the stage here and walk you through some of the details of the Betashield strategy.
Okay, thanks, Brooks. Let's talk about what is Betashield and what it isn't. So Betashield is a disciplined risk mitigation strategy. It seeks to mitigate large losses in the markets, that is, avoid catastrophic losses. However, it also seeks to capture the upside of the equity markets, and it's also very liquid and very transparent. What it's not is a market timing strategy. It's not a guarantee. It's not always hedged. It's not an illiquid black box that you can't understand. And it does not protect against acute or quick gap risk, such as we saw in 1987. And we also saw a little bit of that in March of this year. So that's what it is, and that's what it's not. And I think it has a lot of potential for different types of investors. Let's go to the next slide, please. So there are actually 5 different Betashield portfolios: fundamental, opportunity, and global equity. Fundamental has basically is 65% stocks, 35% bonds allocation. Opportunity is 85-15, 85% stocks, 15% bonds. And global equity is all the global equity market. We also have one that is purely associated with the U.S. stock market. That's the U.S. equity strategy. And another one that is completely allocated to international stocks. That's our Betashield international strategy. Importantly, each one of these strategies has a target maximum drawdown. So in the case of the fundamental, the target maximum drawdown is 12%, or 88 cents on the dollar. For opportunity, the target maximum drawdown is negative 15%, or 85 cents on the dollar. And for global equity, as well as U.S. equity and international equity, the target maximum drawdown is negative 18%. Now, it's not a guarantee that they will never drop by more than that, But the important point, and we'll go over this in the next couple of slides, is as the markets get choppy and as volatility picks up, these strategies begin to systematically de-risk the portfolios and go into cash positions until the market volatility calms down. Let's go to the next slide, please. So there are basically three components. There's the global allocation, which we talk about. There's also the loss tolerance, the amount of drawdown that is targeted as its maximum. And then there's something called a ratchet function, which is very important to be able to stay relevant as portfolio values increase. Let's go to the next slide, please. So here's an example of the ratchet function. We basically start with a $100 value, and as the market moves up to $105, there's a new ratchet. So negative 15% from the $100 level would have been at $85. But then when we ratchet up to the $105 level, the new 15% floor, if you will, is $89.25. And then as the market goes up to $110, the 15% floor from that point is now $93.5. The point is we need to ratchet up the level of the portfolio as it increases in value so as to stay relevant with respect to its target maximum drawdown. Let's go to the next slide, please. Here's an example of how Betashield de-risks, and this is one of the most important aspects of this strategy. I should point out that all of our Betashield strategies went to a completely de-risked position in the month of March. They began in February and they were completely out of the market and fully invested in cash or fully uninvested from the markets by roughly midway through the month of March, or maybe the third week in March. And this shows an example of how that de-risking process takes place. So in the first part of this chart, you see the market going up, and Betashield is completely exposed to the market. There's no de-risking that takes place. However, after the market starts to decline and volatility starts to pick up, the Betashield portfolio first goes to a 25% cash allocation. If that decline continues and market volatility stays high, it goes to a 50% cash allocation. And if that volatility continues and the market continues to drop, it'll go to just a 25% market allocation with 75% held in cash. Then during an extreme event, such as we saw last month, it will completely exit the market and be a portfolio that is 100% invested in cash, 100% removed from the market. Truth be told, this week, some of the Betashield strategies began reinvesting in the market portfolio because the economic impact of the virus seems to have subsided somewhat. Markets have rallied and volatility has come down. So essentially what we have seen is illustrated on this hypothetical example on this page. As the markets begin to bounce back up, the risk mitigation strategy relaxes and the portfolio goes from primarily invested in cash to hopefully a time in the near future where we are fully invested back in the market portfolio. So that gives an overview of how Betashield works. The point is, when markets are rallying, the Betashield strategies are fully invested in the markets. And when markets are selling off and volatility is high, Betashield removes exposure to the capital markets in a systematic way. This systematic approach has been developed through decades of research. It performs, in our opinion, very, very well. Proof is in the pudding in terms of its ability to de-risk as it did during the months of February and then became fully de-risked in March. And then it re-risks as market conditions improve and the markets are on the road to recovery. Again, this is not a guarantee. There is the possibility of sustaining some losses in Betashield, but we firmly believe that Betashield is an excellent strategy to allow investors to participate in market rallies, to protect against catastrophic losses, and most importantly, to reduce the amount of volatility that they experience, providing a smoother ride while getting exposure to the capital markets. So why don't I stop there and hand it back to you, Brooks?
Yeah, thanks, Tony. I appreciate that. So we know that was a lot of information. Hopefully you found it interesting and valuable. We want to leave you with several key takeaways that we feel are the most important. You know, if you don't remember anything else in this presentation, here's a few things that we wanted you to take away. First of all, with regards to the market commentary, the governments are taking action around the world to attempt to get economies through these unprecedented and difficult times. The COVID-19 epidemic and the economic impact of social distancing are very likely going to continue to cause a lot of headwinds and uncertainty in the markets, which, you know, I would say is likely going to cause some volatility for the foreseeable future. To growing your wealth, you know, the importance of having and sticking to a well-crafted and maintained financial plan that's customized for your specific goals and needs, in my opinion, is critically important for your long-term financial well-being. Everyone knows that these type of events are going to happen, but no one can know when they're going to happen or how severe they are going to be. So after they happen, it's too late to plan for it. So, you know, I highly recommend getting with Reid and Barry Financial to talk about how they could plan for the future. Betashield, it offers a managed solution to reducing exposure to catastrophic losses in your portfolio. So, you know, while offering participation to those longer term uptrends in the market, it may be a good solution for you. Again, you know, I would say if you want more details or to see some proposals or analysis, you can certainly get with your Barry Financial team and we can help you run some analysis and help you see some proposals there. So I'll transition it back to Reid. Thanks everyone for listening. We appreciate the time this evening.
Awesome, Brooks. Awesome, Tony. And that right there is why Barry Financial Group and Alphastar have all of my money. And it's going to stay that way, no doubt about it. Just incredible information that y'all gave, and just super blessed to have y'all on. Y'all are some of the brightest minds in the financial space. You know, Mr. Barry's been doing this over 30 years. And, you know, we're always trying to get better and add more value to our clients and to our family. The Betashield strategy is just another sword in the shed, if you will, that we can offer you. So it's not right for everybody. That's why it's very important to get together and call myself or Mr. Barry. You know, when I first started working, I told Mr. Barry, you know, hey man, you gotta work another 5 years at least. And then, you know, after I started working, I'm like, man, come on, you gotta work another 10 years, please. Now I want him to work another 30 years. Mr. Barry's going to be working till he's 95 if I have anything to say about it. And, you know, we make these partnerships with great firms like Alphastar to be able to offer our clients and our own families the best financial tools and best financial strategies. So y'all invite a friend. You know, we do a lot of dinner seminars, and Ruth's Chris and all these restaurants have obviously shut down, which is why we brought this 7-week webinar series to you. And, you know, with our dinner seminars, you could always attend a dinner and bring a friend. That was a very non-threatening way, if you will, to introduce a friend. But now with these webinars, just forward the webinar link to your friends and family. If you think that they can add value to your friends and family, send that link to them and make sure they put your name down. We do a lot of referral events with different client appreciation events and different tickets and gift cards and things. So please make sure to do that. That's the biggest compliment you can give us. So how do you schedule a meeting? You know, you work with Barry Financial to get to Brooks and Tony and Alphastar. So that's very important. Myself, Richard Barry, the Barry Financial team, we are your wealth counselors, your advisors. So go to www.barryfg.com/schedule a meeting. If you're interested in learning about the Betashield, if you're interested in the Alphastar and the models that they have that we can give you access to, then go to barryfg.com/schedule meeting. barryfg.com/schedule meeting. And Barry Financial has been giving retirees and pre-retirees peace of mind through safety since 1987. We had a marketing piece with the Betashield. It was our chief marketing officer, Kyle Owen, came out with it. It's called The Perfect Partnership. And what a really amazing thing that really is, because our average age client is 65. And we don't think it's about making great returns anymore. More specifically, especially at this point, it's about avoiding great losses. Who said you had to lose 40% just to make a solid rate of return? Nobody. And that's the thing with these index annuities, with the Betashield products and the different asset allocations that we can give you, it makes sense to make sure that what you want is what you're getting and it matches your risk tolerance. And that is our goal, is to give you peace of mind through safety, which we've been doing since 1987. So it's been a true honor and a blessing to have Brooks and Tony with us tonight. I hope everybody is staying safe through COVID-19. Remember, barryfg.com/schedule meeting. I hope y'all stay safe. Thanks again for joining. God bless.